Now, earlier we talked about GDP as a measure of production within the economy, but there are different ways of splitting up GDP. There's the production approach, which we discussed earlier. And again, what that does is that's your basic definition of GDP that tells us that GDP is a measure of production. GDP can be measured by recording how much output rolls out of all the factories, the offices, and other facilities across the country. If we add up production from all these facilities and value it at market prices within a given period of time, it gives us our measure of GDP. But GDP can also be measured by taking what we call a spending or sometimes an expenditure approach. Under this approach, GDP is measured at the point of sale rather than at the point of production. All the output that rolls out of those factories, those offices, and other facilities in the economy goes on to be sold to someone. We use market prices to value this output in the production approach. So all we're going to do here is we're going to add up the sales at the same market prices, and it will provide us with the same figure for GDP. Now you might wonder why worry about taking two different approaches? Because it's very difficult to gather all of the information necessary to get a good measure of GDP. Sometimes you have the sales figures available to you, so you can take the spending approach. Sometimes the production figures are readily available, so you use the production approach. But because of the vast amount of information and the delays in that information becoming available, we need to understand multiple ways to calculate GDP. The national spending approach stems from what is known as the national spending identity. This is the national spending identity. Y equals C plus I plus G plus NX. Y refers to nominal GDP. C is the market value of consumption goods and services. We'll define this more explicitly in another slide. I refers to the market value of investment goods. It's important we know what investment goods are, again, to be defined in just a moment. G refers to the market value of government purchases, and NX or net exports refers to the market value of exports minus the market value of imports. So let's look at each of these components individually. Let's start with consumption spending. This is spending on goods and services by households or individuals. So this is your spending on food, clothing, education, transportation, insurance, healthcare, anything that you as a consumer buy for your personal use, your computer, your iPads, your cell phone services, and so on. Investment spending is private spending on things like machinery, equipment, tools, plants that are used to produce future output. So you can think of investment spending as spending by firms for the most part. However, investment spending does include the purchase of new homes. Whenever a new home is produced in a given year and sold, the value of that home is included in investment spending. The reason why is that home is going to produce housing services for families over a long period of time. So we refer to it as investment good. So for instance, if a house is sold for $300,000 in 2013, that house has an implicit rent. Every month it could have been rented, let's say, for $4,000. And it's that implicit rent that would be included in the consumption spending. Over the course of a year, if you're spending $4,000 a month on rent or implied rent on this house that you own, then in the course of a year, the economy is producing 4 times 12 months, $48,000 worth of housing services. This house, which was sold now, is going to be producing these future services. So we include the actual value of the house when it's sold in investment spending, and then the services that it produces in consumption spending. Investment spending also includes inventories. And these are unsold produced goods. So LL Bean makes a bunch of those shirts that we looked at in an earlier video, but is unable to sell all the shirts. So it has produced something of value in this year, but it was unable to sell the shirts in this particular time period. The value of what it's produced we still want to include in GDP, but we include it as inventory. So it hasn't been purchased by a household, so it would be included as something that was implicitly purchased by the firm, which is yet to be sold. Government spending includes spending by all levels of government. your state government, your local government, your federal government on final goods and services. So the government provides educational services, so the pay that would go to teachers would be included in government spending. The pay that goes to our servicemen and women who are in the military, that would be part of government spending. The roads that the government builds, other services provided by the government would be included in government spending. This does not include government transfers like Social Security. When they give somebody a Social Security check, it is literally just a transfer payment, what we call a transfer payment. And once the person receives that Social Security check, they're probably going to use it to buy food, clothing, pay for health expenditures, what have you. So in order to make sure that we do not count the value of that Social Security check twice, once when the government cuts the check and the second time when the recipient of the check spends it, we only include the check as part of GDP when it is actually spent. The fourth component of the national spending approach is net exports. Net exports is the value of exports minus the value of imports. What are exports? Exports are goods or services that are produced here within the United States but sold to a resident of another country. An import is the market value of goods and services that are produced outside of the U.S. borders, regardless of who they're produced by. Could be produced by an American company in Mexico, but purchased by U.S. residents. That's considered an export. And so net exports is the value of exports less the value of imports. Here you see basically when you look at the spending approach, who's doing the spending. In 2007, we see that total GDP was about $14 trillion. 70% of what was produced was consumed by households. About 15% consumed by firms, about 20% consumed by the government. Well, if you add all that up, it exceeds 100%. But what happens here, when you take net exports into consideration, we see that it's a negative number. So that suggests that we import more than we export. On average, we see that over a roughly 60-year period, net exports has been negative. Consumption has consistently been the largest portion of GDP expenditures. Investment and government expenditures are roughly equal. But you may be wondering, why do we net out the imported products? We're looking at what consumers spend. Earlier we said that what we spend is equal to production. Well, obviously, whenever we buy foreign goods like foreign produced automobiles, foreign produced clothing, foreign produced wine or cheese or food products, we are spending some of our money on goods that are not produced in the United States, and we want to reduce that. We want to net that out from our total expenditures so that we can get a measure of GDP where spending on nationally produced goods is equal to the production of nationally produced goods. So that's why we net out the imported products. A third way to calculate GDP is to take what is known as an income approach. Since all the money that is spent on domestically produced goods and services is received by someone, tracking the money that is spent on goods provides another way of measuring GDP. So ultimately, every penny that is spent on a good that is produced here in the United States will make its way to the pockets of those who had a hand in producing that good. So in this approach, each dollar of spending becomes somebody else's income. If we add up the different types of incomes, it will result in the value of total spending, or GDP. Here are the different types of income. So nominal GDP is equal to wages, which is the income that is paid to workers. It's equal to rent, plus rent, which is equal to the income to landowners, plus interest payments, where interest payments are defined as income to the owners of capital, and it's equal to, as well, the summation of the profit, or income to the business owners or the entrepreneurs. So every dollar of spending eventually either ends up in the hands of workers, landlords, owners of capital, or the entrepreneur. Now, there is a caveat. Obviously, not every dollar that is spent is income, because you have things such as taxes, you have leakages from the system. So there are adjustments that must be made in order to get the two approaches to balance. And we're not going to worry about that identity, those accounting identities in this course. It's good enough just to understand that with a few adjustments, you can show that the expenditure approach is equivalent to the income approach of of calculating GDP. Now, which approach do you want to use? We've looked at several approaches here to calculating GDP. Which one is the right one? Well, that answer depends on what it is that you want to study. If you want to understand business fluctuations, the business cycle, why the economy sometimes grows really fast or faster than trend, why it grows slower than trend, then it's worthwhile to study the national spending approach. And that's going to be the primary approach that we take in this class. So don't think that you're never going to see this information again. This is going to pop up explicitly when we look at what causes short-run fluctuations in the economy. And so it's important that you understand the different components of GDP that make up the spending approach. Now, if you want to study how the incomes from production is divided among people and resources, then it's worthwhile to focus on the factor income approach. So that's an interesting question that some of us want to study. If the economy is producing more goods and services, who is getting the income? Is it going to the entrepreneurs in the form of profits? Is it going to the workers in the form of wages? How is that income being divided up amongst the people? And finally, just to summarize what we were trying to get across in this section, is that there are three ways to calculate GDP. You can calculate the value of production in the economy, or you can calculate the value of spending in the economy on those produced goods and services, or we can calculate GDP by taking an income approach. All these are equivalent. And so it's really important that you understand this basic relationship. We can talk interchangeably about production or income or spending within an economy.